What's up, guys? Hope you're doing well. James here from jamesdforsythe.com. So I wanted to give an actual example, right? So we've talked about how Paul Warburg was basically an advisor in some form or fashion to multiple different committees and boards and whatever you want to call them, pretty much everything, during the creation of the Federal Reserve, right? Including the Aldrich plan, right? Which we've talked a little bit about in depth in previous videos, right? And so what I want to do is give an example of how he kind of pushed, I don't want to say pushed, but how it was directly after the Aldrich plan and how he kind of molded his advice to really fit what they found there, or what they kind of decided on for the Aldrich plan, when he was basically advising or going to a conference for, I believe this one was for the National Board of Trade, and it was a monetary conference in January 19th, 1911, right? So basically trying to kind of, after the Aldrich plan was kind of crafted and that kind of stuff with the whole Jekyll Island meeting, how that was applied to kind of a more political setting in a way. Granted, I don't know, I say political loosely, right? So basically outside the whole conspiratorial secrecy realm sort of thing. And I say that explicitly because, quoting him from his book itself, he says, "So I knew, of course, what proposals the chairman of the Monetary Commission was about to recommend," basically Aldrich coming out and with his plan and all that sort of thing that was decided at the Jekyll Island meeting. And so, but having been pledged to secrecy, I could not mention them to my colleagues. At this point, the colleagues are the members of the New York Chamber of Commerce, the Produce Exchange of New York, and the Merchants Association of New York, right? During this kind of National Board of Trade conference, right, in early 1911. So it was most important, however, to have our resolution for those three commissions, groups, associations, whatever, to be framed in general accordance with the findings of the Monetary Commission, right? And so really kind of trying to craft whatever they come up from that meeting, the conference, with the different boards of trades and that sort of thing, with what they found at the Jekyll Island meeting, right? And so there had been, talking about Aldrich himself and why he hadn't come out with it yet. So according to Warburg's side of things, he was, Aldrich became ill, basically. And so he says there had been delay after delay in the publication of the commission's plan by Senator Aldrich. The uncertainties of the congressional situation, no doubt, baffled him greatly and dictated a policy of extreme caution. His tendency to procrastinate was aggravated, moreover, by his physical condition, which at the time began to alarm his collaborators, right? So he became severely ill, right? But I remember explicitly in, I think it's The Origins of the Federal Reserve, written by Murray N. Rothbard, right, to where he puts more weight on the congressional situation, right, on why Aldrich hadn't come forward, right? And so it wasn't just he was ill and didn't want to come do it. There was more of a political motive to that sort of thing from that side of things, right? So to continue, right, and so basically during this whole conference with the National Board of Trade and that sort of thing, that very afternoon, however, as the New York delegates to the Washington conference were passing through Philadelphia, the evening papers brought before the public for the first time an outline of the Aldrich plan, right? And so they really wanted to kind of actually originally bring this plan up and kind of have the public see it in a way, not basically make it known, right, that this was created at this conference for the National Board of Trade, but nothing was said by Aldrich about doing it, according to this. And so it was basically like they ended up just kind of putting it in the newspapers at that time, right? And so kind of looking at a reviewed plan of this meeting in general, so at a very comprehensive account of the monetary conference of the National Board of Trade was given by the delegates of the Chamber of Commerce of the state of New York upon their return from Washington, and then basically gives a brief resume, actually written in response to that conference, right? So that's where I get the date. It was in Washington, January 19th of 1911, right? And so the National Board of Trade today substantially endorsed the principles of the Aldrich Plan of monetary reform by adopting the resolutions offered by the Chamber of Commerce of the state of New York, the Merchants Association of New York, and the New York Produce Exchange, recommending a central banking organization, right? And that's another kind of argument of how the different sides, being the Aldrich side of things, to where they created their plan. They didn't want it to come across as a central banking organization, actually explicitly having Aldrich say this is not supposed to be central banking, it's supposed to just be centralization of reserves, but decentralization of banking power, right, is how he kind of describes it, right? And so, and that's kind of said throughout this resume, because keep in mind this is written from the National Board of Trade, right? So kind of a different perspective of it in a way. And so basically a modern financial system which must rest upon credit supported by adequate gold reserves can be safe and efficient only if so organized as to enable the concentration of idle cash in one reservoir and to render such cash always speedily available for all legitimate needs, thus assuring confidence, right? And so this is really hammering home the point of the centralization of reserves, that they basically was like, this is why, the banking panic of 1907 with the trust companies and all that really happened, was there was no, since reserves were so decentralized, they couldn't flow to where they needed to go, right? So basically you had individual banks fighting each other for reserves at the expense of the other ones, right? So basically the whole argument was that if you centralize them all in one pool, all the reserves could flow to where they were needed, regardless of location. Whereas you were kind of screwed otherwise, and it was really more of an individualized free market in a way, beforehand, to where if a bank didn't have enough reserves, they had to get them essentially from other banks or in some form or fashion, right? And that would be at the detriment of those other banks. So it was really more of a kind of survival of the fittest at that time before this happened, right? And so a central bank system and the most efficient instrumentality for this purpose, providing the means for such concentration of cash and assuring the transformation into cash whenever needed of deposits, commercial paper, and other proper forms of credit, conserving the gold resources of the nation and maintaining the same at a safe proportion of its cash obligations. So it kind of seems like it's the beginning of almost reserve requirements in a way, for it to be a safe proportion to its cash and obligations. Just kind of putting that in there. And then they go into, in their short resume, of the arguments against kind of the previous system. I think I've done an explicit video on this on its own, so I'll try to find that and put that in there as well. But really just kind of hammers home the same thing that we've been talking about. So the scattering of reserves, so they need to be centralized to basically fix that. And then basically the old system prevents the utilization of reserves and the mobilization of the resources of banks, kind of an explanation for why they were needing to centralize them in the first place. It substitutes stock market loans for the discounts of commercial paper. We talked about this a little bit in there as well, to where it was basically like they would use these the stock market call loans, right, rather than having an actual commercial paper market, which was more developed in Europe, and which was kind of Warburg's argument for developing one in the United States. And his argument was basically that should be the foundation of the kind of lending per se of that central banking organization, not necessarily the whole stock market call loan things. And there's a whole separate kind of argument and rabbit hole that goes with that, which will probably be in a separate video, right? And so finally, it provides for note issues absolutely irresponsive to business requirements, right? So this is kind of the whole, like, this organization, the central banking organization, for lack of a better term, is supposed to basically increase the money supply or the note issue when basically the economy's in a downturn. It's supposed to be countercyclical, right? Kind of the whole Keynesian argument for the fluctuation. I don't know why I'm throwing consonants in there, but basically increasing reserves when they're needed, decreasing them when they're not, right? The whole kind of moderating the boom bust cycle in a way. That's kind of where that argument's coming from. And then obviously there's whole other arguments of to why that completely failed, but we're not going there. But basically, to quote the resolution from this resume that the National Board of Trade gave, was that this convention unequivocally declares itself in favor of the creation for the United States of a central banking organization based upon the following principles, and it lists 10 different principles that basically are just the Aldrich plan, more or less, and are obviously shown also in the Federal Reserve Act, right? And some ones to kind of just put out there are basically incorporated banking institutions are supposed to become the stockholders. We see that with the stock capital in the Federal Reserve Bank itself, with their 6%, I believe, at the time. I don't know if it's changed, but when it was originally created, it was like a 6% dividend, right, for those stockholders, basically the depository institutions, and they were the only ones who could have that dividend, right? And this is shown in limited to a fixed moderate return for the dividends itself, and profits in excess of such dividends, right, would basically go to surplus. They had an emergency fund and a whole bunch of other stuff, which we'll get into more nuances later. Also an interesting one that's kind of contrary to what this is now, and this is also, I believe, not only is it explicitly stated in the original version of the Federal Reserve Act, obviously it's been revised since then, but also Warburg gave a huge argument for it later outside, I think after the passage of the actual Federal Reserve Act itself, basically that it shall not allow interest on deposits, right? And keep in mind this is the Federal Reserve, or what became to be, or what eventually became the Federal Reserve, that they shouldn't allow interest on their deposits, which means depository institutions, and they're talking about bank reserves. So the whole IOER, IORR, what it used to be, now it's just IOR, I think, because they combined the two. And I think I did a post on this on basically how interest on excess reserves and interest on required reserves, IORR and IOER, right, essentially became the same rate for so long that they just kind of mushed them together and just had IOR, or at least on how they published that data on the St. Louis Fed website, right? So it's just kind of an interesting thing I wanted to point out was the whole, I think Warburg, it's been a minute since I read his argument explicitly, that he described how putting interest on reserves would essentially destroy the system itself. I don't remember if it may not have been that hyperbolic, but we'll get into it later at some point, right? And so I just kind of wanted to get on here this morning and give you guys a kind of quick example of how Warburg was using the Aldrich plan, right? And how he basically, because granted, the Aldrich plan was modeled after his kind of own proposals in a way, because remember he did his own kind of, I guess, thought experiment, whatever, where he published his own his United Reserve Bank, I believe is what he called it, for the United States, and basically his idealized version of how he thinks it should work. And then basically that's how he advised everything else. And then when this went to the Aldrich plan, it kind of changed a little bit. And then from here, you know, when the Aldrich plan fell through, and then Carter Glass and them kind of took over to create the Federal Reserve Act, Warburg was also advising them, and so it kind of changed a little bit more, mostly just in the power structure in a way, to where it became more of a public rather than private entity, and you had more kind of power in a way go to the Board of Governors rather than the presidents of the district banks, right? So kind of a switch in there, and different committees on who exactly would be allowed and that sort of thing. But that's a future separate argument, right? But anyways, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.